Equitas Small Finance Bank is the first counter in focus on the back of its Q3 numbers. We were able to get hold of N Vasudevan, who is MD and CEO of the Equitas, and here's what he has to say about the company.
In terms of credit cost, if you see, 86% of our advances is non-microfinance, which is actually secured book. And in that 86%, our credit cost remains at a very comfortable level. It's about 1.1% for the quarter, as well as for the 9 months, it's at similar levels. And so there is really no concern from a credit cost and quality perspective, as far as our secured book is concerned, which is about 86% of the book. The pain really coming in from our microfinance portfolio, which is about 14% of the book. It was 19% when we started the year. It's actually been coming down because our disbursements have slowed down during the year. And so the book has actually been coming down. Now, as far as the microfinance credit cost is concerned, yes, we did see a small improvement in Q3 compared to Q2, but I would say that it was more notional because in Q2 we had gone in for extra buffer provision. And that is why the second quarter credit cost was at a higher level. But otherwise, if you look at the portfolio per se, between second and third quarter, the portfolio actually kind of remained at similar levels of X-bucket efficiency. The credit cost is about 10% for the third quarter. Now, in microfinance, what happens is that when an account slips from X bucket to an overdue bucket, it takes 90 days for the account to become NPA, assuming that we don't collect it. And then over the next 2 months or 3 months, it gets 100% provided. So typically, credit cost is a 6-month lag from a X bucket flow. So that's why you see Q3 credit cost is a reflection of our Q1 slippage. Now, Q2 was actually worse than Q1. So Q4 credit cost might actually not improve much. So we might see still a similar level of credit cost in Q4 also. But Q3 was slightly better. So maybe Q1 of next year, we might see some small improvement. Now, but the whole challenge is Q4, this quarter. How is our X-bucket efficiency going to play out? If that plays up really well, and if we start improving, we are at 98.2% in Q3. If that goes to anything around 98.6 or so, more or less the product becomes a break-even product. Right now, it's loss-making. The income minus the credit cost is negative. But if it reaches 98.6, more or less the product breaks even. So the whole question is in Q4, will our X-bucket efficiency go to 98.6? So that's the real challenge in front of us. We have done a lot of work from the bank side as well as industry side. We have got some guardrail 2.0, which has been rolled out in January. And we'll have to see the impact of all of that, whether the quality of borrowers and the quality of portfolio across the industry, as well as for us, whether it will really improve in Q4 or maybe Q1. And in which case, we might see elevated credit costs for this quarter and next quarter. And maybe Q2 or Q3 is when we might start seeing some level of normalcy coming.
Fair point. And so the margin contraction is also equally sharp. Is that at all a concern? And where do margins therefore lie for the next couple of quarters at the very least? Could pressure continue to sustain?
Yes, so our NIM came down by about 30 basis points in the third quarter compared to the second quarter, which itself was 30% lower than the first quarter. Lastly, the reduction in NIM contributed by the fact that microfinance as a portfolio has been coming down from a contribution perspective, and it has an impact. In the third quarter, out of 30 bips drop in NIM, 20 bips came out of the drop in microfinance portfolio, and 10 bips was a one-off where the treasury income was a little on the lower side. But 20 bips was more or less contribution from the microfinance. So if for the next 2 or 3 quarters, if you are going to look at our NIM, you might see contraction by similar levels of around 15-20 bips. But what we expect is that over a 3 to 4 or 5 quarters, slightly in the medium term, microfinance as a percentage of the book would have already come down sharply by that point in time. And so the effect of any further drop in microfinance won't have much of an effect on NIM. So I think the microfinance based NIM effect might last for another 2 to 3 quarters.
Another 2 to 3 quarters. Okay, understood. And is it 20 bips a quarter or 20 bips overall, the contraction expected from here?
Right now, it has been 20 bips per quarter.
Yes, understood. Okay. Okay. And so just trying to therefore gauge your other book is growing at a fairly healthy clip, which is your secured book. Can that continue and will that start to take center stage? And is the strategy now going to be to reduce reliance on microfinance, and therefore where should normalized NIM be?
Yes. So the rest of the book has been doing quite well. Our credit cost, as I mentioned, is at about 1.1%, which is very comfortable. And the rest of the book has grown by 20% year on year for the third quarter. And we expect that level of growth to continue in the rest of the book. And so to that extent, yes, they should offset some of the effect that we are seeing from the microfinance book. The other important element is that, in Equitas, we have about nearly 85% of our book, which is a fixed rate loan book. Hardly 15-17% of our loans are floating rate. So last 1 year, 1.5 years, when the interest rates have been going up, we have actually been having the negative impact of that because our cost of funds went up, but 85% being a fixed rate, our earnings was not going up. But assuming that there could be an interest rate reversal scenario over the next 12 months, then we will actually see the reverse effect, which is that we will see a benefit on the books because our interest earnings won't be coming down, large book being fixed, whereas our cost of funds might actually start coming down if the interest rate reversal happens. So we might actually have some kind of tailwind from the interest rate movements that is possible over the next 12 months. So a combination of that plus contribution from the rest of the book, non-microfinance, I think the effect of NIM drop because of microfinance might get mitigated over the next 2 quarters.
Okay. And so just give us color on the ROA therefore. Your credit costs have been elevated last couple of quarters, but are recoveries starting to come through in Q3? Because that's something you suggested. Slippages have started to come off. So how is Q3 and Q4 looking in terms of recovery? And therefore should ROAs now steadily expand even though there could be some pressure with regard to the provisions that you're making? How should one look at the ROA trajectory?
As I mentioned, the credit cost from the rest of the book is not a concern. It's largely the microfinance, and that I think will remain as an issue for at least Q4 and Q1. I think that's fairly clear because of the fact that Q2 and Q3 was only 98.2. So there will be some elevated credit costs between this and next quarter. And then Q4, Q1, we'll have to see how that pans out for predicting the credit cost for the subsequent quarters. From a ROA perspective, I think, somewhere by second half of next year, we should try and see a much better ROA because by and large, the microfinance would have played out by that point in time. And the rest of the book continues to grow well. And the cost of funds might see a dip if the interest rate reversal starts happening over the next 3 to 6 months. So a combination of all of this, I think the second half of next year is when we might start seeing an uptick on our ROA.